Okay, we're busy with question 5. And in this question, we're just going to look at the journal entries for the adjustments. And don't forget to add the description for each adjustment. Okay, so you'll see this is the pre-adjustment trial balance, okay, which you will find over here, pre-adjustment trial balance, okay, and this is before adjustments was done. Okay, and then there's specific adjustments given. 1, 2, 5 over here. Alright, so we're going to look at these adjustments and we're going to do it in this format. Okay, so this is what was given. Okay, so it's on the last day of the month. You have to debit and credit something at the amounts over there and give a description over here. So you have to do it for all of them. If anything has to do with debtors or creditors, you also have to add it over there. Okay. Right, so the first adjustment. 800 Rand interest is still owing on the loan. Interest is not capitalized. Okay, so which loan is that? Let's have a look and see which loans we've got over here. And you will see that the loan is of 20,000 Rand for Absa. So it's a liability. Okay, so that interest that we've got is a interest on a loan, which is an expense on a liability. Okay, so that 800 Rand interest is still owing on the loan. Interest is not capitalized. Okay, so let's have a look at the answer there. Okay, so you still need to add, you still owe that, so you must increase the interest on the loan. Okay, so there must be more interest, which is in expenses, so you're increasing expenses on the debit side. And if it's an expense and it's on the credit side, so it's either PE or EP, okay, prepaid expense is an asset, and this must be a liability because the amount must be on the credit side. So it can't be a prepaid, so expense payable, accrued expense or expense payable. Alright, it's the same name for that. So there must be more liabilities therefore, and interest on loan must be debited. So more expenses, and therefore you have to credit the other account, and therefore it must be a liability. It can't be prepaid expenses, which is an asset. Okay, and then you say interest owing brought into account. So that's how you got your marks for that one. Okay, rent is owed for 1 month. So let's see what rent is that. And you will see here it's a rent expense, and they say rent is owed for 1 month, which means this rent that we've got over here, there's 12 months in a year, so this is only for 11 months. So to work out 1 month, we take the 19,800 divided by 11. Okay, 19,800 divided by 11, and that's 1,800. Okay, so again, it's owed for 1 month, it's again expense, so it's again expense, accrued expense or expense payable, EP, right? And rent expense must be increased with 1,800. How did we get the 1,800? It is the 19,800 divided by 11, because they say you still have to add 1 more month, which means the 19,800 is 11 months, and that's how you got the 1,800. So we increase our expenses with 1,800 to get to the amount that it should be, and again it's expenses, so it's EP, expenses payable, 1,800, which is credited. And again we say rent owing for 1 more month. So that was number 2. Wages, number 3, wages of 1,600 have been prepaid to an employee in financial difficulty. So wages is an expense. It has been prepaid. So what is prepaid? Prepaid expenses will be, is it an asset or a liability? It will be an asset. Okay. Prepaid expenses will be debited, and you've paid this 1,600 to this employee, but that's not the normal circumstances. So this was because he's in financial difficulty, which means we have to decrease the expenses and we have to credit the wages and salaries. Okay, so two ways to work it out. Salaries and wages is decreased because it was too much, or because it's a prepaid expense, I know already it's an asset, so therefore I debit it, the other account must be credited. Amount paid in advance is your description. Number 4. Provide for depreciation on equipment at 10% per year on the cost price. So we're going to have a look on the equipment, what the equipment is. 55,000 Rand, 10% of that is 5,500. Okay, and there you will find it. Depreciation will be debited, accumulated depreciation on equipment will be credited. Okay, and you say depreciation at 10% per annum on the cost price. And then lastly, the two stock counts. Following stock counts were on hand at the end of the financial year per physical stock count. Trading stock 46,700. Now 46,700 is what you found. So go have a look and see what the trading stock was showed at. It says 47,000. So your book shows 47. You only find 46,700, which means there's a 300 trading stock deficit. Okay, so what I'm going to have to do is I debit trading stock deficit, which is an expense. I credit trading stock because I want to decrease my trading stock with 300 Rand, and I say trading stock deficit as per physical stock count. Last one, consumable stores regarded as a sundry expense of 240. Okay, so consumable stores regarded as a sundry expense of 240. So what do you normally do at the end? You take it to the specific asset. Consumable stores on hand, that's what you should normally debit at the end of the year, because you're showing it as an asset which is normally debited. But normally you would say consumable stores would have been credited, but this consumable stores is regarded as a sundry expense, and therefore we have to credit sundry expenses. Because what is happening now, you can't show that as an expense because you've got it left. Therefore you have to minimize your expense to show that you didn't use that 240 Rand worth of consumable stores. And then consumable stores on hand as per physical stock count. So that's all the adjustments for question 5.